Just to touch upon what I mentioned at the start, why we selected this particular topic. So I think that the thing that needs to be understood when you are Sri Lankan and when you have gone through, I mean, all of us who have been living in this country have gone through, kind of economic ups and downs over the last, I would say, 15 to 20 years. As Sri Lankans, we tend to be quite risk averse. Naturally, based on the kind of things that our economy has gone through. We have gone through obviously 26 years of war. We've gone through tsunamis. We've gone through kind of almost independent terrorist acts of terrorism. We've gone through the economic crisis. So with all of the things that we have gone through, there is also this kind of risk averseness that comes naturally, where people want to kind of go in for safer and more kind of secure investments, right? So when you look at it in the grander scheme of things, everyone has this idea that they should save money. And what we kind of look at is the fact that people are looking at savings, but they don't quite understand the distinction between savings and what investing really means. So part of the problem that what we see is the fact that in most cases we have been conditioned to think that there is only one way to invest, or there is only one asset class that we should be focusing on. Most people, for most people, that asset class is probably fixed income. So that's the traditional relationship that we have with saving. We associate with opening a bank account, putting it into a savings account, or at the very extreme of that kind of thing, maybe putting it into an FT for a year or 2 years or 3 years or what have you. But the thing is, the way that investing or personal finance works is that because there are so many different asset classes available, diversification is the most sensible option. So we are not here to kind of promote the view that you shouldn't be putting money into fixed income and instead you should be putting money into equities. That's not what we're saying. That's not great advice to begin with. It's just that it's about allocating. So when you have, like for example, a couple of years ago, we had interest rates go as high as 30%. So you could go and get a T-bill or a T-bond that was paying you 25 to 30% interest, which is an incredibly high rate of return. But of course, you have to take it in the context that inflation at the time was about 70%. So in kind of economic theoretical terms, you're basically talking about your money depreciating, not appreciating, because obviously inflation is 70% and your return that you're getting is capped at 25 or 30 or whatever. So the reason why we advocate for that diversity is that when you have different asset classes that you can go into, you protect your basically your ability to spend money, or your kind of what we call purchasing power parity or whatever. You protect that because of that diversity, right? So why we wanted to select this particular topic is to kind of give a sense of what's the distinction. Why should you as new investors or people that are investing in other asset classes look at equities as an option? It is not, by no means are we saying that it is the only option. It just needs to be part of your broader financial portfolio that you have, so that you can get the benefits of when, for example, the market is doing well. Now, the reason that as I mentioned at the start, that it is very timely is the fact that now we are going through a very different interest regime. So right now what we're seeing is that interest rates are quite benign and expected to be relatively flat for the foreseeable future. So what that means is that if you are someone that was used to getting 15, 20, 25, 30% from your FDs, then now you're getting used to getting 6% or 7%, and that is where you can look to other asset classes to obtain that additional return. So that's why we wanted to pitch equities as an option. And I think that what we are hoping to address in the slides, that the ensuing slides, is that there are a lot of misconceptions when it comes to investing. There is a misunderstanding out there about how the market actually works and how you can use the market to kind of invest. Because I think the most important thing that needs to be understood is that when it comes to the stock market, one size does not fit all. So if you are a 25-year-old, you should not be treated, or your portfolio should not look like a 50-year-old's. And if you're 50 years old, your portfolio should not be relatable, or it should not look identical to a 75-year-old's, because all the risk appetite and your income levels. Obviously, if you're very early into your career, you can, even if you kind of take risk and lose money, you can make it back. If you're someone who is 75 years old, retired, then you obviously have no you're relying on the investment returns rather than an actual like a salary as an income, right? So those distinctions are very important to understand, and I think that the more that people appreciate the nuance and the difference between what it means to, because if you want to be someone that takes a lot of risk, you can there is a way to kind of come into the market. If you want to be a little bit less adventurous and want to stick to, for example, stocks that give you continuous dividends, that's another strategy that you can use. There is a way that you can customize your investment strategy for your needs while kind of still investing in the market. The market has that length and breadth in terms of depth to basically find different avenues for you to invest. So that's what we are trying to do. So and I'd like to kind of also just say that if you look at what we're trying to kind of encourage people to do is to just kind of ask questions of themselves as well, to look at, hey, is this the right fit for me? The one last point that I want to make is that towards the end of the presentation, we are also going to talk about something that's very close to our hearts at John Q Stockbrokers. It's a campaign that we launched last year for International Women's Day called She Invests, and my colleague Devniti Sera, she'll be taking you through a few slides on that. That is something that obviously, given that it's March and International Women's Day is around the corner, this is something that we're a campaign that we're very, very we feel very strongly about, and she will kind of give you more input on that. So without further ado, let me pass you on to my colleague Stefan De Silva, and thank you very much, and hope you have a very informative session. Thanks a lot.
Hi guys, so just like Nithila mentioned, we're going to be touching on a few concepts today. So basically the roadmap of what we want to cover is going to be an introduction to equity. We'll give some key terms which should ideally make you guys familiarize with what happens in the stock market. We will see how equity looks compared to fixed deposits. Then we will look at the importance of starting off investing early. We'll look at some of the market risks, then the benefits of diversification, and then common misconceptions about the stock market. So going into it, these are some of the very, very basic terms. This is we mainly put this slide for the benefit of some of the people who are looking at the stock market for the first time. So we actually asked some of our interns also some of the doubts they might have had when we've done initial presentations, and the term equity is sometimes not used very commonly. So equity, stocks, shares, they're all the same thing, exact same thing. It's basically a unit of ownership of a company. So you hear a lot of people talk about equity markets. They're basically talking about the share market. And then when you talk about a portfolio, it's a collection of different stocks, right? So you can say investment portfolio, which might comprise of fixed deposits, bonds, and shares. But when you say equity portfolio, essentially talking about exclusively a collection of different stocks. When you talk about share price, we refer to the current price that a share is trading at. And when you say target price, it's essentially a price that analysts forecast based on valuations you've seen in the past, based on multiples and things like that, which we'll also get into what multiples are in a later slide. Then the term bull market is something very common. I think most people would have heard of this term, bullish and bearish. So just to make things easier, think of a bull market, or try and picture a bull when they kind of charge at someone, their head is facing upwards and the horns are facing upwards. So think of that as a market moving upwards. And then a bear market, think of it as a bear charging and he has his head down. So it's a market declining. You would have also heard of the terms liquidity, turnover, volume. They're all interchangeable. They all basically refer to the level of activity in the stock market. So when the market is down, when there's not much interest, what you'll notice is that the turnover or the liquidity of the market is very low. So if you're a shareholder who has a large quantity of shares and the amount of that particular share traded for a day is very low, it will be very difficult for you to exit your position or even buy a position. Then when you talk about the stock exchange or market, it's just like any other market, right? So in a normal market, supermarket, you'll have goods and services traded. Stock market, it's just publicly listed shares that are traded. So in Sri Lanka, our stock market is referred to as the Colombo Stock Exchange, and within that you have 284 listed companies. The total market cap is about 5.7 trillion. And then indexes are essentially a way of tracking the movement of different shares, right? The different prices all kind of brought about to one place. So ASPI is the most common one. S&P SL20 is essentially Standard & Poor's Sri Lanka 20, which is a list of the 20 most liquid shares in the stock market. So in 2024, performance of the ASPI was very strong. It was about 49%, and then S&P was around 46%. So if we start comparing equity versus fixed deposit, I mean, like Nithila said, most people, even our parents usually, when they tell us to save something, the main thing they go for, or the main thing you think of, is savings accounts, right? Fixed deposits. So the differences between fixed deposits and equity, if you look at return potential, and we will see this in a later slide as well, equity has a much higher potential for returns. Of course, sometimes there's a higher level of risk involved, but that's all part and parcel. So fixed deposits, stable, predictable. It's good if you want to set aside some money for a year or 5 years, and not think too much about the external factors that can affect your deposits. It's much less risky compared to equity, but again, like I mentioned, your return is going to be limited. Right now, the rates go at about 7 to 8% on FDs. Yeah, in terms of risks involved, so subject to market fluctuations, there are moments in time when you might buy a share today and it might come down tomorrow, or the price might continue downwards for about a week or so. But see, there are strategies also to mitigate this, and we will visit those strategies again down the line. But what you need to think about when you invest in the stock market is that you need to take a long term view. So yes, the share might be down tomorrow or it might be up tomorrow, but in the long run, in about a year or 2 years time, the gradual trajectory is usually upwards once you see a recovery. So fixed deposits, like I said, minimal risk, guaranteed return. So you already agree to the rate of return at the moment you go to the bank and set aside your money for that fixed deposit period of 1 year or 5 years. The bank will tell you, look, you're going to get 8% annual interest for the next 1 year. In terms of liquidity, a huge advantage the share market has versus a fixed deposit is the fact that you can take the money out whenever you want. So obviously, if you put your money in an FD, a fixed deposit, you have a period which you agree to, maybe a year to 5 years. You can withdraw your money in certain instances, but there will be a penalty fee on the fixed deposits, which you don't have on shares. So taxes is actually a big selling point for equity versus fixed deposits, because right now there's no capital gains tax on equity. You do have a 15% withholding tax, so that is on dividends. But in terms of capital gains, if you make 100%, you're not going to get taxed on that. Whereas fixed deposits, your interest income is basically going to be added to your total income, and then depending on what tax bracket you're at, you will get taxed. So again, suitability for different investors. You could be a long-term investor, and that will be very beneficial because, like I said, there can be fluctuations within the short run when you get into shares. So if you are willing to hold something for about 2 to 3 years, chances are you will make very good returns on this. And like we said again, fixed deposits, you just want to set your money aside and then hold, not think about it too much. So ideal for conservative people expecting a fixed level of return. So in terms of your forms of return, right? I mean, if you look at fixed deposits, we all know what you get paid is interest, right? It's very plain vanilla. There's nothing else. But in terms of what you get from equity, there are different forms of return. For example, capital gains essentially refers to the difference between the price you sell a share versus the price you buy a share. So if a share goes, let's say you buy a share today and it's 100 and it goes to 200 rupees in a year's time, you essentially double your money. So there's a 100% gain on your investment. Then when it comes to scrip dividends, that is essentially a form of distributing the company's wealth. But what the company does is it rewards the shareholder by giving them more shares. So those shares can then be sold in the stock market and you can get money for it. In terms of cash dividends, it's essentially a direct kind of amount of cash that comes to your bank account if you hold the shares of a company. And then rights issues is basically a way for a company to raise money from its shareholders. So a right issue is is not an obligation, but it's an opportunity. So if you want to subscribe to a rights issue, you can go and buy more shares of a company at a discounted price, but you don't necessarily have to do so. If you don't want to put more money into that company, you can sell your shares or your rights on the stock exchange. So dividend is actually a very important concept, and it's something that basically gives shares characteristics of FD, right? So now the level of dividend is not a fixed thing like a fixed deposit. It varies, but it's usually quite consistent. So you will see patterns over time, and you will have things like dividend payout, right? So just to give you guys an example of how dividends work, think of a company who basically has about 10 shares in total. There's no other shares. And then for 2024, they had a total earnings of $100. So basically, your earnings per share is going to be that 100 rupees divided to your 10 shares. And that gives you an EPS, which is another common term, earnings per share of 10 rupees. Then the company decides to pay out a dividend, right? A dividend of 50 rupees. So they've essentially, from the 100 rupees they've earned, they're paying off half of it as dividends. So that is what you call a dividend payout, that 50%, the amount of dividend relative to how much of earnings you made for that year. So then if you want to calculate the dividend per share, like I said, there's 10 shares and they've paid a total dividend of 50. So you can get your dividend per share of 5 rupees. Your dividend payout is the 50% I mentioned above, and the dividend yield is a very important concept. It's essentially the same thing as your interest rate you get on an FD. So, for example, now if you bought a share at the price of 5 rupees, then your dividend yield is going to end up being 10%. Because what we said was you had about a 50 rupee total dividend being paid out by the company, and that works out to 10%. So when you talk about dividend yield, in practical terms, you will think about the share price today. And for example, if a company has a share price of 10 rupees today, and they pay you a dividend of 1 rupee today, you buy the share today at 10 rupees, and at the same time, you get a dividend of 1 rupee. That's essentially a 10% return on what you've done. So that is similar to putting 10 rupees in an FD for 1 year and getting 1 rupee in terms of interest. It's almost the same thing. And if you look at equity versus fixed income, so these are some of the most commonly used kind of rates for comparison. The 12-month fixed deposit rate is around 7 to 8% at the moment. 12-month treasury bill, which is pretty much the safest investment in the country because you consider the government liable to make payments on that. And since the government can print money, people consider it to be somewhat risk-free. So it's 8.35% on the 12-month T-bill. And if you look at stocks, like I mentioned, which pay that high dividend yield, where dividend yield is an equivalent of sort to interest income. So you have Valuable Power who paid 12.6%, Union Assurance who's paid 7.6%, Ceylon Tobacco 9.7%, and Distilleries which has paid 11.1%. So very, very strong dividend levels or dividend yields. So it's some of them are actually higher than what you'd get in a fixed deposit. So in addition to this dividend yield, you're also going to get, like I said, the capital gain. If the share price appreciates over time, over 1 year, you will have this dividend yield, plus you'll have the capital appreciation. So one interesting thing we saw over the last 2 years, back in 2022, we saw interest rates, just like Nitila mentioned, they shot up to about 25-30% when inflation was about 70%. What was interesting is that banks also have performed extremely well in terms of capital appreciation, even if you look at the last year, right? So on the right-hand side, the small table, what it shows us essentially is the fixed deposit rate 1 year ago, start of 2024, was about 10.8%. But if you had invested your money in Commercial Bank or HMB or Sampath, you can see the level of return for each of those banks, right? So Commercial Bank gave you pretty much a 50% return, HMB an 88% return, Sampath Bank a 67% return over the year. So essentially much higher returns. And what I think a lot of people, again, they move into FDs because of that safety factor. But if you really think about it, when interest rates went to 25%, 30% at the middle of 2022, the reason interest rates went so high was because there was a bit of a risk about whether banks would be able to pay back their deposits, right? So banks were also very desperate to raise deposits because what had happened was banks had lent out a lot of money to the government, and the government was essentially defaulting. So when the government was defaulting, the banks won't show if they get their money back. And then people who put their money in deposits at banks were scared that if the bank doesn't get its money back, can they get their money back? So that is essentially what drove up interest rates. So if you're still willing to put your money in a fixed deposit rate, in a fixed deposit, and take on that risk that the bank has, then why not go and invest in the shares of the banks which are listed on the Colombo Stock Exchange? Because it's essentially the same thing, right? I mean, in terms of safety, if the bank does well, gets out of it, you're still going to get a good return in terms of your share price, and your FD is also safe. But if you're thinking that the bank's at risk, then your FD would also be at risk at this particular instance. So, I mean, it was a super time to get into the banks because this is just from last year, 2024, we are checking. If you checked it from 2023 onwards, you would have easily made over 100% on the banks. And yeah, so moving on to compounding and basically early investing, right? So we've all heard about this compounding interest and interest on interest terms and things like that. And we've all heard people say, okay, why don't you invest when you're young and things like that. But this numbers right here really emphasizes on the importance of investing a bit early on. So there's two things here: individual A and individual B. So basically, individual A starts investing the same amount as individual B at the same interest rate. Okay, so we've taken an example of 10% interest, but the only difference is individual A starts investing at 25, individual B starts investing 10 years later, or starts saving 10 years later, right? Like I said, they're both putting the same amount each year, 100,000, and we are going to see what happens if they invest till retirement, so till about 60. And what is clear here is, so to get the same amount of money at the age of retirement, when both of them get about 10.8 million, individual A only has to invest for 5 years. So on that last column, on the notes, you'll see A invests 100,000 and that goes on for 5 years, right? At the fifth year, he pays 100,000 for the last time, and then his savings, or the total amount he has at that point, is 671,000. So then essentially what happens from that point onwards, it's just the interest getting added to that. So every year there's going to be 10% added on to that, and year after year it's interest on interest, so it's compounding. And then individual B starts investing when he's 35, and he invests 100,000 as well, but he needs to invest for 25 years to make the same amount of money that the guy who invested for only 5 years is going to get. So that is the advantage of compounding. Essentially, you have to pay 25 times the amount, whereas A paid only 5 times the amount. So there's a huge advantage in terms of timeline when you actually go and it compounds. So you can also think it in this way, right? Individual A would invest for 5 years, and then he has no worries. He can just let the money work for him and he can just sit back. Whereas B has to keep putting $100,000 for a good 25 years. And it comes to the same thing. So in terms of strategies, keeping things simple is, I think, very important, especially if you're just starting off and getting into the stock market. Um, I think it's really important to kind of look at sectors that might interest you, maybe something that you're familiar with if you're getting into it. For example, we did one of these She Invest campaigns for the Cinnamon hotels. So I think if you're somebody working in, let's say, the leisure or the hotel sector, then it might be very interesting for you to see how the hotels perform, right? So, for example, during COVID, that was one of the worst times for the hotel sector. Obviously, there was travel bans from all the countries. You really didn't have tourists coming in. But then the prices basically came down. At one point, there were certain counters, certain hotels which might have been seemed cheap. So then somebody who would work in the hotel sector would ideally have friends maybe who would have migrated abroad, and they might be, let's say, for example, working in the Maldives or something like that. And what was interesting about the Maldives was their whole business model in how hotels operate. So it's a collection of islands, which meant that all those hotels were kind of isolated, which is perfect for a scenario where you had COVID, then you had basically social distancing in place, right? So they would actually start to see a recovery in tourism much faster than a country which had most of its hotels kind of clustered within the city. So if you were in the hotel industry and you had, friends or people you worked in the past who migrated and who would give you this color, if you're in communication with them, they'll tell you, look, things are picking up here. You might have also noticed that within the city, certain hotels, the restaurants were doing quite well, even though you didn't have foreign tourists coming in after COVID restrictions started coming off. So then, if you're in that sector, you'd know that. So ideally, what you would do then is you would look for hotels listed on the stock exchange which have exposure to, let's say, the Maldives, and you do get quite a few hotels that do that. And then ones which might actually be able to make enough money from the restaurants and so on. And then you will look into those and look into the valuations. Is it cheap? Will they start to see a recovery? And then you might start thinking it makes sense to buy into those. If you happen to work at a bank, right? If you guys are bankers or something like that, then you might have a lot of color on how people are paying back their loans. Is there an increase in the non-performing loans? Is there demand for credit? What do you think about interest rates? Are they going to go up? Is it going to be beneficial for the banks? So starting off like that might be a good way to actually get yourself into the equity markets. Then macroeconomic trends, identifying regional trends. So macroeconomic stuff is also super important. When you know that the GDP of a country is starting to recover, I mean, last year the expected GDP growth for 2024 is supposed to be about 5%. So that will give us an indication that, okay, we are actually starting to see a recovery from the time when we had petrol queues and gas queues and everything was kind of going downhill and SMEs were defaulting and things like that. So macroeconomic trends are also very important. Where is inflation now? We went to, having inflation at 70% at the worst point in our history, maybe, and then now if you look at the last 4 quarters, we've had deflation. So things are starting to recover in that sense. Interest rates are also much lower than they were. It used to be 30%. Now it's on the treasury bills. It's around 7, 8%, 8.4%. So that means things are recovering. It might be a good time to kind of get into the stock market. So yeah, when you want to evaluate what your investment is going to be, like if you think about getting into a certain stock, there's a few things you need to kind of think about, right? So staying in touch with how the company performs on a periodic basis is very important. So how do you do that? On the Colombo Stock Exchange website, every quarter it's mandatory that the companies release their financial reports. So within these financial reports, you will be able to look at how the company has performed in terms of its profit. If it's a bank, in terms of its non-performing loans, does it have sufficient capital, things like that. In terms of its interest income, its net interest margins, are those things good? Those are things you can all monitor from the financials when they come out. You can also contact your stockbroker and get some color from them. They will tell you how the company has performed, what they think the share price should be, where it's headed. And then the analyst report. So my job in terms of being a member of a research outfit is to do these periodic reports covering certain companies and giving our analysis on it, and where we think prices are going to go, where we think the environment that company operates in is going to go, things like that. And identify the shares which have lower multiples. Now, this is something we'll get into in a bit. What we mean in terms of low multiples, there is a misconception in terms of what makes account a cheap. I think most people who start off in equity or start off trying to get into the stock market, they look at two shares, and if the price of a share is cheaper, they think that value of that share is undervalued. But that's not necessarily the case. The price and the valuation are two completely different things, and we will get into that in a bit. And yeah, in terms of executing, basically have a strategy, right? So like I said, long-term investing will help you kind of protect yourself from panicking and selling just because the market comes down in the next day or the next week, right? You have the ability to set aside money for a year or 2 years. So make sure that the money you set aside is not money that you're going to suddenly require, right? That you don't have to make payments or something like that, which you think you can in a short period of time make a buck and then come back and make your payment. Because by chance, if the share doesn't go in the direction you want, if it doesn't go up and it comes down, you'll have to hold it for about a year. So make sure you only set aside what you can hold for about a year or 2 years in the stock market. And unit cost averaging is also a way to kind of mitigate fluctuations in the stock market. So what you'll notice is the share price never goes up in a straight line. And we can actually see that if you go back to this, right, you can see fluctuations happening from the 2nd of Jan 2024 up until December. You can see it goes up and comes down and things like that. So dollar cost averaging essentially tells you to buy on a periodic basis. So let's say every month, if you buy the same share and you put the same amount, let's say you make 200,000 in terms of income. If you're setting aside 100,000 to invest in the stock market, every month you consistently set aside the money to invest. So there will be points in time where you buy the share at a higher price and then you buy the share at a lower price. But on average, it will even out. So you will have good times and bad times, and that will essentially even out when you consistently put in money each month. So going back to this importance of finding stocks which are undervalued, right? I mean, if you all take a look at these two tables, so we have one on the left which says 1st of March 2024, and then 31st December on the right side. So this is essentially a report we do on a daily basis and kind of release from John Keel's stockbrokers. What I'd like you all to look at is initially look at the two circles, right? So Sampath Bank is 72.9 on the 1st of 72.9 rupees on the 1st of March. HMB is 158 rupees. And then if you think about it, you might initially think that 72 rupees looks a lot cheaper than 158. And now we've got this doubt come up quite a few times when we introduce people to stocks initially. But in reality, valuations are something else, right? So think of price to book as something like a hamper, right? So for example, during Christmas, you know how if you go to a Keels or you go to a Food City or something like that, you will see hampers on display which are being sold. And now what you'll notice is each of those hampers have different prices, right? But why do people still buy something if it's more expensive? It's because they think that they're getting good value from it, right? So for example, one hamper might have a higher quality of alcohol, right? For example, let's say something like a black label versus, let's say, something like an old Derek. So, and then you will have maybe a premium quality cheese, imported chocolates, or something in the more expensive hamper. So, essentially, the price you pay relative to the value might be the same. That is a very similar concept to price to book. So, when you look at something like a bank, this value on the right hand side, right, the last column, 0.78 for HMB, 0.83 for Sampath. Now, if you look at how things were back in 1st March, that number is looking at 0.42 for HMB and 0.54 for Sampath. So it will actually show you that Sampath Bank's valuation is higher when you think about it in price relative to the book value or net asset value per share, right? So it's actually more expensive even though the share price looks cheaper. And how do you justify this multiple? Now, when we did a report in March earlier last year, 2024 March, one thing we looked at is the historical multiple that the share trades at. So this price to book. Now, if you want to say the price is going up, how do you justify it? If the 0.4 should go to 0.78, how do you identify that that movement was going to happen? What you essentially do is you look at how a share has performed historically. So if you look at HMB over the last 10 years, what you'll find out is that the price to book multiple used to be on average around around 1 times, right? So then you need to ask yourself, okay, why is it much lower now? The reason for it was the fact that from 2019 onwards, we've had one black swan event after the other. We had the Easter bombings in 2019, then we essentially went into COVID in 2020, and then afterwards we went into the financial crisis where we didn't have US dollars, we didn't have gas, we didn't have fuel. So things were looking very bad in an economic sense, and the banks were severely affected by it. So the multiple came down. But then we started to recover. I mean, things have gotten a whole lot better. Like I said, GDP is expected to be about 5% for last year. Interest rates have come down. So now, when things are starting to recover, you should ask yourself, okay, now that these black swan events are done, in a normalized period, how did the banks trade? What is this fair multiple for something like an HMB? Then you look at it, how it has performed over the last 10 years before Easter happened, before COVID happened, and that multiple was above 1 times. So then you can assume, okay, if things are getting better, it could go to a multiple of 1 times, and then you work backwards. If this multiple goes to 1 times, then what should the price be? The book value is something you already have. The current book value, the net asset value, it's going to be available in the financial statements that the company releases each quarter, like I mentioned, and then you can work out what the price should be. And us as research analysts as well, we will give you direction as to what that price to book value should be. We will forecast what the book value of the bank would be down the line, and then tell you, okay, in 1 year's time, if the book value is going to be X, this is what the price should be. So that guidance can be obtained from anybody within the brokerage. So if you look at market risks, things that cause fluctuations within the stock market, right? So macroeconomic risks are a huge thing. We've all seen this now in terms of the exchange rate depreciation, how it would affect certain companies, right? So for example, export companies, they are going to be impacted significantly because the companies they export to might actually find it cheaper. So it might be beneficial when the rupee depreciates for export companies, because the people abroad will say, okay, this looks cheaper. So they will start buying more from Sri Lanka. Also, in terms of the LKR performance, the rupee performance, now for each dollar of items they export, they're going to get more rupees. So there is going to be a benefit there. Then if you look at the negative point of view, a company which has a lot of dollar borrowings, for them it's going to be a huge negative, right? Because now if you're earning in rupees and you borrowed in dollars, the rupee starts to depreciate. Basically, for each dollar you owe, you need to find more rupees. So that's going to be a tough thing to kind of do. Then obviously GDP slowing down, that's going to reduce demand for a lot of things, right? For example, GDP slowing down means consumption is going to be low. So business and demand for products and stuff for most of these SMEs and companies is going to be much lower. That is going to impact the final earnings or the profits of the company. Um, Political and regulatory risks is another huge one, and I think we all saw this back last year in September specifically. We saw the market come down quite significantly because there was so much of uncertainty about the political situation of the country. But luckily, we saw the market recover because even though we had a new regime, even though we have a new government come into place, we essentially saw them continue a lot of the policies laid down by the previous regime. So more specifically with respect to the IMF. So a lot of people were concerned that the IMF deal might not go through, or these guys would deviate from the IMF deal, but that didn't happen. Then the market kind of read that as a positive and expected policies to continue. So there was less uncertainty, and the market started to move upwards. So yeah, policy uncertainty. For example, if they bring something like a capital gains tax onto the stock market, that's going to be a huge negative for the stock market. But it doesn't appear to be so. And also, what you need to think is, if you bring something like a capital gains tax, you're going to affect the turnover. That is the number of shares being traded per day, and then there's also for each transaction a tax component, which Devani will touch on later when she talks about the breakdown of the transaction cost. So that if the volume or the number of trades becomes low, then obviously that tax you get from transactions is also going to be less. So regulatory changes, yeah. So for example, the Central Bank Act, the new Central Bank Act, basically stipulates that the government or the central bank cannot print money whenever they want, and that's a huge kind of advantage, because what happened, one of the main reasons for the depreciation of the rupee was the fact that we started printing a lot of money, and when you print excess money, that money eventually ends up going to people's hands and they start importing more. So what happens is you start importing more and more goods, and then the demand for dollars is also higher. So the rupee starts to depreciate. So by controlling the amount of money printed, then you can actually mitigate how much demand there is for imports and things like that. So that is also a positive in terms of the currency or the rupee being more stable. Yeah. So I mean, Sri Lanka is also connected to global markets. Again, going back to that first point earlier, in terms of a global economic slowdown or recession, it just like when the rupee depreciates, it's beneficial for foreigners. At the same time, if foreign markets, if they see a slowdown or if the economy is not doing good, then anyone who's exporting to these foreign markets, for example, some of the apparel companies in Sri Lanka, right? MS, Brandix, if they are, let's say, if they're exporting items to the United States, then if there's less demand for those clothes, right, that apparel, then obviously they are not going to do that well. So that demand is going to be conditional on how well those foreign economies are going to be doing. And then the US Federal Reserve, which is basically the central bank of the United States of America, they whenever they kind of increase interest rates, it will impact Sri Lanka, because high interest rates basically means that if you're offering high rates abroad, it's like a substitute, right? So why invest in Sri Lanka if these guys start increasing the interest rates? There's a bit of a capital outflow. So what happens is when the US increases interest rates, you usually see most other central banks follow suit. I will hand it over to Devni now.
Hello, good evening, everyone. My name is Devni Tisera, and I am a certified equity securities advisor at John Q Stockbrokers, and I'm currently heading a campaign called She Invest. So let me just give you all a small background on this campaign, why we started it. So we at John Q Stockbrokers, we actually did an analysis on our active client base, and what we found out from that was, out of the entire client base, it was only 15% of it were women. And then we actually wanted to find out more on this. And when we speak to them, sometimes they would say, oh, it's my husband who does it for me, or it's my son. And it's what we saw was, it was very like women found it, I mean, they were not coming to the front when it came to stock market investing. So which is why we started this She Invest campaign, because in our country we have 51% of the population are females, and we believe that we need to see more participation by females in equity market. So which is why we launched the She Invest campaign. We launched this last year for Women's Day, International Women's Day, on 8th March. And we actually didn't want it to be like a one time thing, just celebrate women just for 1 month and just forget about it, right? We have been keen all throughout this year, where we have been doing numerous number of awareness sessions on companies, speaking to females in the corporate sector, giving them the financial literacy and the confidence to invest in the stock market. So the main purpose of this campaign is to educate, engage, and empower women to invest for their future. So if you look at why should women invest, so firstly, it's for financial independence, right? So that you don't have to depend on somebody else's income. You can do your own thing, and it'll actually give you a lot of freedom in terms of choice. And the other is the wealth accumulation. So most of us, maybe we could be mothers, we could be wives, or whatever the case may be, especially if you all are mothers, if you all want to build up a good portfolio for your children, maybe so you can, kind of accumulate wealth, just like Stefan explained. You can make use of the compounding effect and, kind of accumulate wealth for your future. And also it'll help you to retire in comfort, so that you don't need not worry or depend on anyone in that case also after retirement, if you have like a steady source of income. And also it'll improve the quality of life, right? Because if you have a secondary source of income coming in, and if you have diversified your investment opportunities, so that you don't really have to rely on one, right? You have the flexibility in terms of your career. And overall, it actually, what we see is when women take control of their financials, they are much more fulfilled, they feel like doing a lot of things. So it actually overall will improve the quality of life. So these are some of the common misconceptions that mostly women, like we spoke to some people internally as well as externally to see what the pain points are and why exactly are they not coming into the picture, right? So some people think like you need to be like a financial wizard or like a math genius to invest in the stock market. Well, that is actually not the case, right? So if I am to tell you how you could uh, go about with this is, so we will enable you with a lot of awareness campaigns like this and a lot of knowledge sharing sessions. And apart from that, if you open up an account, so you're being allocated to an investment advisor like I myself, can actually guide you with the types of stocks that we recommend. And because we have an in-house research team and Stefan was one of them, so they actually do like the background study on the stocks, and always the types of stocks that we recommend are fundamentally strong stocks, right? So we will back you up with a lot of information, a lot of knowledge, so you ideally essentially don't have to be like a financial wizard like to get into the stock market. And the other thing is, some people think like, oh my god, stock market is like gambling. Well, that is also not the case, right? So in gambling, what you do is you put in money and it's all by luck, right? So one minute you might get a lump sum of money, next minute you try your second try, then you might lose everything, right? So it's all on luck and chance, right? But where banking transactions online, like few seconds we can get it done. So this is also, if you get a hang of it, is not very difficult. And we do have a trading guide as well to assist you on a step-by-step approach on how to do it. But basically, when you say to trade, it's basically a matter of fact of knowing what the right stock is through your investment advisor, entering what the stock is, how much of it is the quantity, and what price would you like to buy it, and just execute the order. And then create a watch list means, so basically the Colombo Stock Exchange has 284 stocks in it, right? And not that we would be interested in all the stocks, right? We are very keen on the stocks that we have already invested in or that we're going to invest, right? So basically in the watch list you can filter the stocks that you would want to closely monitor. And also apart from that, you can set price alerts if you are somebody who is very busy and you're unable to watch the market. But if the market is on a bullish trend, the prices are going up, if you want to keep a track of it, you can kind of set up a price alert on it as well to give you a notification. And finally, so why should you choose John Key stockbrokers? Number one is for the reputation and the credibility. So we are a part of John Key's holdings, so everybody knows. And so you shouldn't worry anything about the reputation and the credibility. And in terms of investment research, as I touched upon earlier as well, we always recommend stocks which are fundamentally strong, and we do put out our research content. It's available to all our clients. And we do two types of we do a report called the market strategy biannually, which goes like into in-depth detail of stocks, why we are recommending it, and all. And apart from that, we are in a highly regulated industry, so we have to go by the rules. So regulatory compliance is so you need not worry about the transparency of your transactions or anything to that matter. And also we will enable you with the online trading facility, which has the mobile accessibility, and it's a very user friendly platform. And with that, I'm going to wrap up today's session. And here on screen we have put our WhatsApp channel, so anybody who is interested, whether you're a client or going to be a client or not, it doesn't matter, it's open to everyone. Whoever is interested could join our WhatsApp channel on this QR code, because we'll be sharing some market updates and daily updates on it as well. And apart from that, anybody who wants further information about us, you could search us on www.jksb.com. And anybody on She Invest, we have a dedicated landing page for She Invest, which is also under jksb.com. There is a separate section called She Invest, where we have covered some frequently asked questions. And if you want to be in touch with us, please feel free to get connected. And I have also shared my number on screen. So if you have any queries or any clarifications, please feel free to reach out to me on this number. And thank you very much for attending for today's session, and I hope it was like a fruitful session for all of you. And please be in touch with us if you need any queries. Thank you so much.